everyone, a very good morning to everyone. I hope you all are fine and doing well. So today we are going to start our capsule batch, and in this batch we will try to revise all the important concepts of BFM. Like we will try to cover everything in a very short way and easy way. So we are starting with module A, and in module A, first 5 chapters we are going to cover today in a very easy way. So I hope that I am audible, my screen is visible, everything is okay from my side. So let's start with the class, and if you have any type of problem in between, you can tell me in the comment section. Okay. So first of all, believe you can and you are halfway there. So just believe in yourself and you will obviously succeed this exam also. So if I ask you why we need foreign exchange, as you know that very first chapter is related to foreign exchange, a whole module is related to the international banking. Obviously, foreign exchange is very necessary because for the world trade, like buying and selling in international markets, you can just imagine, you can just then think that forex is just to make the business easy at the international level, and also it includes cross border movement, capital, manpower, all these things are cross border movement. Travel and tourism, if anybody wants from India to travel in Europe, so obviously he or she needs euro, so he will contact authorized dealer to get the euro. So for the travel and tourism, for export of software and services, like if an Indian wants to export some softwares and services at international level, he need foreign exchange. And also remittances by expatriates. So whenever invoice currency is not equal to home currency, currency conversion happens. Means when you can say that $1 is not equal to 1 rupee, so in that case conversion is happen. So example, Indian exporter receives US dollar and converts into INR. Indian importer pays euros, so INR must be converted into euros. So any currency which is not belonging to your country becomes foreign exchange for you. Any currency apart from INR is a foreign currency for you, right? That is a foreign currency for you. Okay, now that's why we need foreign exchange. But the thing is there, uh, that foreign exchange is very important. 24 into 7 market, world largest market. But what is the meaning of foreign exchange? See, if we talk about the FEMA definition, which is under section 2, foreign exchange means, foreign currency means deposits, credits, balance that are payable in foreign currency, deposits, credits, balances that are payable in the foreign currency, draft, traveler check, and bill of exchange that are drawn in INR but payable abroad. Any instrument that are payable only in INR and partially in INR, partially in foreign currency, that is also considered as foreign currency. Means all the claim that are payable abroad, that are foreign currency. So foreign transaction, you can say contract to exchange one currency for another. Exchange one currency for another at an agreed rate, at agreed date, that is called your exchange price or a forex transaction, right? Then forex market structure and features. There are lots of participants in the forex market, generally central banks, commercial banks, investment banks and funds, forex brokers who are the middlemen, corporates and individuals. And what are the characteristics of forex market? It is 24 into 5 days market, because Saturday Sunday is off for whole the world. Then it is global and it has no boundary. It is over the counter market plus exchange traded market, very highly liquid, because uh, assets are sold in this very quickly. Wide participant base, rates changes every few seconds, in every 4 seconds, and it is impacted by government policies and time zones. So there is Indian OTC turnover is now US dollar 34 billion per day. You can imagine, if you compare with the previous years, it is increasing, right? And that's why forex market gaining the demand in the international market as well as in the Indian markets. So what are the factors that determine exchange rate? There are three factors: fundamental factors, technical factors, and speculative. But in fundamental factors, these factors are generally long term factors, in which we include balance of payment, like if surplus is there, like if foreign reserves are in surplus, that means home currency become more strong. But if foreign reserves are in deficit, are in problem, that means foreign currency weakens. So it also helps in economic growth, because if economy is growing good, that means there is a stronger currency. And fiscal policy means when the policies are implemented by the government for taxation, for what is the government spending, that will also affects the foreign reserves. And monetary policy means where it controls money supply and the interest rate. And interest rates also attracts the foreign capital. For political stability, if the stable government is there, that means stronger currency is there. Then we have next factor, that is technical factors. What is technical factor? Technical factors you can say that these factors are where capital flows due to fear. Means when capital flows just because of fear, just because of speculation, like past price trends, there is lot of government control, and here investors are not in a confidence, their sentiment. So these basically related to the capital flows due to fear and speculation. But third factor we have is speculation. And what is speculation? Speculation factor, you can say, buying, selling based on expected movement. It adds liquidity, it can cause short term volatility, right? So this is basically, you can say speculation is related to buying, selling, that is based on expected movement. It adds the liquidity. This is also one of the factor. Now, exchange rate mechanism. What is cash deal? Cash deal, also called ready, that happens on immediate basis, like settlement happens immediately, same day. Tom means tomorrow, means settlement happens tomorrow. Spot, T plus 2, one of the popular deal in the market. That means basically settlement happens after 2 days of deal. And forward deal, any date apart from spot date. That means if anybody locks the deal today, then settlement will happen after 30 days. That is called forward deal. So one of the popular deal is here spot deal. Now spot versus forward rate, you can see the example here. Spot rate means US dollar INR is given, this is the buying rate, this is the selling rate. Euro and US dollar, this is the buying rate, this is the selling rate. Then what is forward rate? Forward is equals to spot plus forward margin. Forward margin means premium or either discount. Premium or discount. If premium is there, that will add it. If discount is there, that will subtract it from the spot. Premium is basically when forward is greater than spot, means if someone locks the deal today at 80 to 40 paise, after 1 month it become 82.45 paise. So you can see forward rate is greater than this price, that means this is the premium. But if forward is less than spot, that is the discount. Right? So basically the forward margins depend mainly on what is the interest rate differential, what is the demand and supply of currencies in the future, capital flows, trade balance, and your political scenario and speculation. Right? So you can see the example here. If the spot price is this, right, and 6 month premium is given 1.06, 1.07, you have to add this 74.95 and forward rate is this. So US dollar is at premium but INR is at discount. Right? And one more thing here, two important rates, direct and indirect quote. What is direct quote? Direct quotes that in which we can say India uses this. When 1 US dollar is equals to suppose 74.95, local currency is available, that is called direct quote. But what is indirect quote? When local currency is fixed. So US dollar is quoted directly against almost all the currencies. US dollar is quoted against every currency except British pound, euros, Australian dollar, and these are basically we have to use indirect quote. Clear? So what is fixed rate? Fixed rate is that is packed by central government. It allow movement with the bands. And what is floating? Floating matlab flowable, means which is determined according to the factors whatever going in the market, and most of the countries now following this floating system, including India also after 1993. Fixed, in which everything is fixed by the central government. It allows the movement within the bands, but floating means determined by the market forces. So what is the meaning of integrated treasury? When a single unit that manages bank funds, investments, risk, forex operations and the liquidity. When there is a single unit that manages all the things, whatever related to the bank funds, investments, risk, forex operations, liquidity, everything, that is called integrated treasury. It ensures that banks earn a lot of profit with minimum risk. So everything that are managed by a single unit, that is called integrated treasury. So what are the functions of integrated treasury? CRR and SLR management and investment mix. What is CRR? Cash with the RBI capital cash reserve ratio. Cash with the RBI is, you can see, CRR, and SLR is generally statutory liquidity ratio, which is government securities. So treasury ensures that compliance plus decides how much to keep in bonds versus other investment. Compliance means everything must be according to the rules, and it also decides how much to keep in the bonds and comparison to the other investment. So if SLR is 18%, so treasury decide which government securities to buy for the good yield. Right? So basically integrated treasury is one of the important thing you can say, and it is very important for a bank to earn the profit. Then integrated treasury helps in liquidity and the management of funds, and also asset liability management. Basically asset liability management, where assets and liabilities mismatches are managed. Then it helps in risk management. It controls all the treasury risk. It helps in transfer pricing. Transfer pricing means decides internal interest rate for the business units. It helps in using the derivatives like IRS option forward to protect the bank exposures. And then it helps in arbitrage. Arbitrage means if I got something in this market at cheap rate, I will buy from this market and sell to the another market where the rates are very high. That is called the arbitrage, right? That is called the arbitrage. So capital adequacy, where I, it means bank ensures investment and risk are aligned with all the capital and Basel norms. Everything is according to the capital and Basel norms. So it is important. So if we say in this chapter we have to revise types of deals, integrated treasury, forex rate, that is the only important thing. And treasury chooses quality assets. Why? Just to avoid losses. That's why it helps in reducing the non-performing asset levels and also reduces the provisions. Now here you can say, what is the meaning of derivative? Derivative, when the values are derived from underlying asset, foreign exchange commodity, equity, bond, that is called derivative. And we have the very important thing, three offices we are having. Like, what is this treasury structure? Front office, mid office and back office. Front office is the main room, that is dealing room, where traders and dealers are there, where they quote the rates, they do the foreign exchange deals, they fund the nostro and they manages the position, and this is the profit center. Mid office is generally responsible for the risk management, in which there are independent of dealers. They check all the limits, they do the market analysis, they do the model valuation, and they are following all the compliance and the reporting. And back office, where confirmation, all the reconciliation is happening, settlement is happening and accounting is happening, right? It is important to avoid any type of fraud and the misreporting. Then derivative, which is basically used for hedging, speculation, and futures means, what is future? Future is basically a standardized contract, and it is traded on exchange. It, in this, margin is required, and it in this basically prices is equals to the demand supply on the exchange, right? So we can say that, what are the RBI internal control guidelines, where proper system and there is functional segregation, everyone know what they have to do. There is access control for different users, confidential data protection is there, global dealing limits for domestic and foreign branches, ensure that bank has sufficient capital for treasury activities, and they have to use value at risk model for market risk. Value at risk model means this model is useful to determine the extreme level of losses, right? Then model validation regularly. It is important that models will give the exact predictions. Then communicate limits to each other. All deals, they have to follow NOPL, IGL, AGL, stop loss, country limit, counterparty limit, everything. All deals have to follow this limit. And profit and loss evaluation at monthly foreign currency closing rates, which is basically called FEDI rate. So RBI performs a very important role just to ensure that everything is going according to the rules and regulations in the forex market, so everyone can do the business without any hesitation and any problem. right? So we have types of risk here. uh, Operational risk, loss due to people, process, and external events. Exchange rates means exchange risk, when the risk occurs due to the fluctuations in the currency. Credit risk, when one borrower is not able to pay back the bank any interest, any principal, any EMI, that is called credit risk. Then we have liquidity risk, when not enough cash available in the market, that is called liquidity risk. Gap risk or interest rate risk, when there is a mismatch between the maturity dates of forex purchase and sales. And market risk, when there are changes in the market factors, and these factors causes the market risk. Legal risk, any type of penalty issue, any type of case is there, that all are called legal risk. Country risk, when there are restrictions in the country due to government intervention, that is called country risk, right? So these are the types of risk. Then here the difference between forward and futures. So what is the difference between forward and future? You can see here, forwards are happen over the counter, but futures are happen on exchange market. Forwards are flexible, whereas futures are standardized. In forward, their margin is nothing, but in future there is the margin. On forward, settlement happens on maturity or uh, cancel the contract. But in future there is daily mark to market value, and there is daily offsetting. Liquidity is basically low here in the forward case, and in the future case liquidity is generally high. But the thing is there, what is the meaning of this forward market and what is the meaning of this future market, or forward contract and future contract? See, forward contract, you can say that, are those contract which are private, customized, and are according to the parties, right? Whereas future contracts are generally those contract which are standardized, and these are legally binding agreement just to buy or sell an asset at a predetermined price on a specific future date, right? These are customized and private type of agreement according to the parties. These are standardized, and settlement happens on the future date. Clear? So this is the difference between forward and future market. Then we have here, suppose exporter expecting US dollar 1 lakh after 3 months. If US dollar depreciates, so obviously exporter will lose the money. So solution, lock the US dollar rate using the forward contract today, right? And if importer needs US dollar after 2 months, so if US dollar appreciate, the cost increases. In that case, forward contract is the solution, best solution for the importers as well as for the exporters, right? Is that clear why this is important? Forward and futures are important. So what is the meaning of swap? See, swap, this is an agreement between two parties, that they are exchanging their cash flows for short period. They are exchanging their cash flows for a short period or for a predetermined period or set period. These are flexible. They can be designed to meet the specific needs. There are very many types of swaps. First one is interest rate swap. So in the interest rate swap, what is the meaning of this? Interest rate swap generally, here fixed rate cash flows are exchanged with floating rate cash flows. There is no principal exchange, only the interest difference. It is generally used to hedge the interest rate risk. Suppose if company paying floating rate, right, but wants fixed rate, so it will enter this in this interest rate swap and pays the fixed amount of interest and also receive the floating rate, right? So this is the interest rate swap. Now we have currency swap. What is the meaning of currency swap? Generally, currency swap means where exchange of currency plus interest in two different currencies. Means if suppose INR, borrower swaps the INR loan interest with US dollar loan interest, in which currencies exchange happen and also the interest in the two different currencies. It protects currency risk plus interest rate risk. Then third one we have zero coupon risk. Zero coupon swap. What is zero coupon swap? Zero coupon swap where one party pays nothing during the period and at the last pays lump sum amount. And it is very useful where cash flow is very tight, and that's why zero coupon swap is there, where party pay at the end all the amount, right? Then option is a contract that gives the right but not the obligation to buy or sell a currency asset at a fixed price within a certain period. There are types of swap. Call option, which is used for imports. You want to buy US dollar in future, you will buy a call option. Put option, right to sell, which is used for export. An exporter wants to sell US dollar at safe rate, it will buy a put option. Means call option, it is used for importers, and put option is useful for the exporters. Who is buyer and seller? Buyer is basically the holder, and who is seller? Writer, grantor, that receives the payment. So option, you can generally learn this thing. It is a contract that gives the right but not the obligation. Then what is FEDI? FEDI is a self-regulatory organization established in 1958. It coordinates with the RBI. It publishes the benchmark rate. It trains the bankers. It ensures that everything is according to the rules and regulations in the forex market, and it also manages interbank for a broker guidelines. Whatever the banks internally are doing will be according to the guidelines. So FEDI is one of the most important organization for the forex transactions. And what is forex exchange global code? This is a global code for fair, transparent and disciplined forex dealing room operations. Like every dealing room, whatever it is, front, mid or back, they will do work with complete rules and regulations and in a disciplined manner. So that's why foreign exchange global code is used for this fairness and for this transparency. It is adopted by RBI and FEDI, right? So in the forex arithmetic, whenever TT buying rate is used, so bank buys the foreign currency, and whenever the TT selling rate is there, bank sells the foreign currency. In the inward remittance, bank purchases the foreign exchange, so it will apply the buying rate. And in the outward remittance, when the money is going out, so that means bank sells the foreign exchange, it will applies the selling rate, right? So this is the concept of forex arithmetic. And also here we can say that some important thing in the if we take the example of inward example. So customer get US dollar 1000 to the bank via Nostro, right? So bank apply TT buying rate in that case. If TT buys suppose 83.20, that means amount credited is 1000 multiply by 83.20. If the TT buy rate is 83.20, so that means a customer gets already US dollar 1000 to the bank via Nostro. So in that case, what is the amount credited? Rupees 83,200, right? An outward example, suppose customer wants to send US dollar 2000 abroad and TT selling rate is 84.10. So in that case 2000 multiply 84.10, which is equals to 1,68,200. This is the selling rate in the case of outward example, right? Is that clear? So in the first chapter, what the things are important? First of all, learn about the foreign exchange market. What is the exchange rate? What are the guidelines? What are the three different dealing rooms? And what is the integrated treasury, FEDI, and something about the forex arithmetic rules. That is enough. Okay. So I hope that this is clear. Types of swaps and types of option. What is forward rate? This is the only important thing in this first chapter. I hope any problem is there, kindly ask me in the group, in the chat box. Now, very interesting chapter, LRS, liberalized remittance scheme. What is liberalized remittance scheme? This is the scheme basically which helps the residents or companies just to remit the money or receive the money, foreign currencies, but in a limit. Lots of things are happening in this. Let's learn about this very interesting chapter. So first we have to understand what is the meaning of capital account transaction and what is the meaning of current account transaction. See, whenever there are changes in the assets or liabilities, whenever anything alters the assets and liabilities, that is called capital account transaction, right? Any transaction that changes the asset and liabilities of a resident in India, outside India, a non-resident in India, whenever their assets and liabilities are changed or altered, that is called capital account transaction. Anything that create or changes ownership of assets internationally, that is called capital account transaction. Example, I am buying a house abroad, you are buying a house abroad, that is capital account transaction. Investing in the shares of a foreign company or an overseas company, that is called capital account transaction. In opening a foreign bank account abroad is a capital account transaction. Wherever my assets, anybody, individual's assets changes in basically liabilities and assets are changed, that is called capital account transaction, the most important thing in our LRS, right? Then we have here current account transaction. What is the meaning of current account transaction? Current account transaction related to the daily activities. Daily activities means basically anything apart from capital account, and they are day-to-day expenses. They are related to the day-to-day expenses. For example, if someone wants to pay abroad for import and export, they want to they want to send money for medical treatment, they want to send money for who are studying abroad, they are remitting money to the children for living expenses. These all are current account transaction. So you can see the example of capital account transaction. When a resident invested US dollar 20,000 in Google share, That means they are creating the asset outside the India. So capital account transaction is the example of this, right? Then if a parent sends $5,000 to son abroad for education, that is called current account transaction. I hope that this is clear. What is the difference between current account transaction and capital account transaction? Capital account transaction, any transaction that alters and that changes the liabilities and assets, that is called capital account transaction. Current account transaction, where apart from uh, any transaction apart from capital account transaction is current account transaction. Is that clear? Now there are the sections, very important sections under the FEMA, for means important section of FEMA under the LRS. So let's learn about these sections. First we have section 4. Section 4 means there is restriction on holding the foreign assets. According to the section 4 of FEMA, there is restriction on holding foreign assets. Residents cannot hold foreign assets freely unless they acquired those assets when they are NRI. They acquired those assets when they are NRIs. So these are allowed, right? They use the, if they are using the liberalized remittance scheme legally, that is, it is also okay. Like how it is possible? Suppose husband wife is there, like husband limit is 2,50,000 per year and same wife limit is $2,50,000. They jointly invested in a house abroad. Everything is in the limit of $2,50,000. That means that is valid. They can hold that foreign assets outside, right? So because they are using the liberalized remittance scheme legally, right? Now section 6 is saying, which is related to the capital account transactions. Capital account transaction allows the resident to buy, sell foreign exchange for permitted capital transactions, but within the limits are same for everything, $2,50,000. Then we have section 10 subsection 6, which is misuse of forex. Misuse of forex, it relates to misuse of forex. Suppose if someone purchased for one purpose, like someone purchased the foreign currency but not used for that purpose, it used for another purpose, it is not surrendered within 182 days, unspent money, so that is all the contravention of the FEMA, and in that case penalty is there. So if someone buys $10,000 for the travel and but use it for other online investment, that is called violation, right? Then we have very important section 11. In section 11, basically RBI can give direction, demand the information, and also imposes the penalties on the authorized dealer. Who are authorized dealers? Authorized dealers are those persons or those banks, institutions who get the license from the RBI to deal in foreign exchange, right? And section 13 is relates with penalties. What are the penalties? Basically penalties up to 3 times the amount involved, and up to 2 lakh if amount is not quantifiable, right? If we don't know about the amount, then in that case 2 lakh rupees. But if amount is quantifiable, then 3 times of that amount, plus if anybody is still continuing the contravention, that in that case additional 5,000 per day is there, right? So what are the non-permissible prohibited remittances that can't be done under the LRS? Margin payments are not allowed. FCCBs of Indian companies like foreign convertible bonds are not allowed. Callback telephone services, banned obscene magazines which are banned in Indian, but anybody wants subscription of these magazine, that is not allowed. Lottery winnings or purchase of lottery tickets, that is not allowed. Income from horse racing, gambling, not allowed. Dividend balancing related remittances, not allowed. Commission on exports to wholly owned subsidiaries and joint venture, that is also not allowed, right? So if all these things are not allowed, so what is allowed? There are permissible things with the government approval in the schedule 2nd. According to the schedule 2nd, there are permissible activities but with the government approval. What are these? Basically, if someone wants cultural tour, that they have to take the permission from Ministry of Culture. If someone wants to advertise any thing in foreign media, they have to take the permission from Ministry of Finance. And basically, if someone wants to give the money for sports remittance, so in that case, if that money is less than $1 lakh, that no permission is required. But if the money is more than 1 lakh, then they have to take the permission, right? So government intervenes and they said you have to take the permission for all the things if anybody wants to do anything in the foreign area, right? Now, permissible under delegated powers. See, if someone in the schedule 3rd LRS, if someone travel abroad, that is permissible except Nepal and Bhutan. If someone wants to gift or donation, allowed. If someone permanently settles or moving abroad, employment abroad, studies abroad, maintenance of close relatives, business travel, training, medical treatment abroad, health insurance, purchase of art objects, all these are allowed under the schedule 3rd, right? But there are some general guidelines under the LRS. General guidelines under the LRS. What are these general guidelines? See, limit is there $250,000 per financial year, right? Limit is same $250,000 per financial year for all the current plus capital account transactions, right? So PAN card is mandatory. PAN is mandatory. There is no restrictions on the number of transactions. Anybody can do number of transactions, but limit should be under 250,000 per financial year, right? And if there is new customers, they have to go through with the due diligence and bank statement. Funds have to come from legitimate savings and income. Credit cards can be used for current account spends, right? But how to release foreign exchange in the cash? See, in the case of Iran and Russia, full amount in cash allowed. In the case of Iran and Russia, full amount is allowed, right? Then in the case of other countries, US dollar 3000 is allowed except Iraq and Libya, because in Iraq and Libya US dollar 5000 is allowed, and in other countries US dollar 3000 for Hajj travelers as per the Hajj committee guidelines, that is according to the Hajj committee. And unutilized forex must be, whatever the unutilized forex, they must be returned to the authorized dealer within the 180 days. There is a limit of 180 days in that case of unused foreign exchange, right? So this is the thing. Now here, gifts and donations, anybody can gift to person outside India but cannot gift to another resident foreign account, right? And there is a definition of Companies Act 2013 applies, but in that definition everything is involved related to the relatives, but not the stepdaughter, brother's wife, daughter's son, they are not allowed. Then medical treatment up to US dollar 2,50,000, this is allowed, no permission is required. But if someone wants more than this money, so they have to show the doctor estimation, and that in that case they can allowed more than 2,50,000 after showing the doctor estimation. If someone wants to studies abroad, they have to like up to US dollar 2,50,000, again it is allowed. But above this limit, if university demands more than this amount, then they have to show the proof. Then students abroad treated as NRIs in the India, and their resident account is the NRO account. Clear? So this is the basically studies abroad case. In the case of medical or study, more money is allowed, but they have to show the proof. Tax collected at source. There is one change in tax collected at source, so I will tell you according to that change. Tax collected at source is basically a type of tax that is deducted. So what is it? What is the basically 20%, more than 20% is not now deductible for more than 20%. Let me explain about you this. Just a minute. See, if just ignore this one and listen about this. In the case of education, that is basically loan, in that case no taxation up to rupees 7 lakh. But in the case of above rupees 7 lakh, 0.5% is needed, right? Then in the case of medical treatment or in the case of education where no loan is there, again there is nil up to rupees 7 lakh. This is according to the earlier rate, right? So don't confuse in this. I will tell you the new rate. So this is basically nil up to 7 lakh, and there is 5% above rupees 7 lakh. Got it? Then for other purposes, what is the earlier rate? Nil, again, up to rupees 7 lakh and 20% above 7 lakh. That is correct. Like up till we learn this thing that this is the rate. But now the new rate from 1st of April 2025. New rate will be their education. In the case of education that is financed by loan, there is no TCS. In the case of medical treatment and for the education that is not financed by the loan, in that case this is basically nil up to rupees 10 lakh and 5% above 10 lakh, right? And for other purposes, again, nil up to rupees 10 lakh and 20% above 10 lakh, right? So this is the earlier rate and this is the new rate. So you have to solve all the things according to this rate. Clear? So this thing is important. Okay. Clear? Now, capital account transactions under the LRS. What is allowed? Buying immovable property abroad, that is allowed. Shares, listed, unlisted, that is also allowed. Debt instruments, mutual funds, allowed. Setting up joint ventures and wholly owned subsidiaries is also allowed. Foreign currency bank account abroad, it is allowed. Loan to NRI close relatives, it is also allowed. And if any sector which is prohibited for ODI by the individuals, that like overseas direct investment, that is prohibited. Real estate business, banking, financial services, FATF non-compliant countries, no step down subsidies for wholly owned subsidiaries and joint ventures. Everyone have to use one authorized dealer for every type of transaction, only one branch, and there should be account exist for at least 1 year. Their credit facilities are not allowed, and family remittances allowed if all are co-owners, right? Family remittances are also allowed if all are co-owners, right? Okay. Just a second. I hope that now this is clear about the LRS and about the foreign exchange. Now we are going to learn about the here about the correspondent banking. Correspondent banking is also one of the important thing. So let's start with the correspondent banking. So what is the meaning of correspondent banking? See, suppose in India any bank wants to serve their customers in another country, right? But there is no branch of that bank. In that case, this Bank of India will communicate with the banks of that country and ask them to serve my customers on behalf of myself, of my bank. I will pay you a fee. Another bank agree to this. That is the concept of correspondent banking. Everywhere, every branch is not possible, so in that case the concept of correspondent banking is there, right? This is the concept of correspondent banking. Is that clear? Okay. Now, if we talk about the correspondent banking is one of the most important concept. Why important concept? Because it helps all the banks to survive in the market easily, right? So that's why correspondent banking is one of the most important concept. Now the thing is there, what are the things we are going to learn in this correspondent banking, and why have to use this correspondent banking. So let's learn about this. Correspondent bank is a foreign bank that provides services to another bank, that is called correspondent bank. Think like it think of it as a friend abroad who does work on your behalf, right? So why correspondent banking is needed? Because bank cannot open branches in every country. There is very high cost and licensing restrictions abroad, and they need cross border trade payment. NRI remittances depend heavily on correspondent banks. It allows the Indian banks to service the customers worldwide at low cost, and also it supports global financial inclusion. Suppose if there is an exporter in the India that ship goods to the Germany, payment will be received through SBI US dollar nostro account that is maintained with the US bank. So here that bank is basically a correspondent bank, and there that is the bank, basically the respondent bank. Clear? So what is correspondent banking? Where one bank do the business in the behalf of another business. That is the concept of correspondent banking, right? Now the international trade today runs smoothly because bank across countries are connected like global network. International trade today runs smoothly because of because because across countries are connected like global network. Suppose bank in the India foreign banks to help them with sending and receiving money across the countries, handling the export import documents, settling the trade payments, servicing the NRI customers abroad. That's why we need correspondent banking, where in India bank use the foreign banks to help them with these all the activities, right? So Indian banks cannot open branches everywhere. They depend on correspondent banks abroad, right? So SBI does not have a branch in Brazil, but SBI uses local Brazilian bank to make receive payments from the SBI customers. Is that clear? What is the concept of correspondent banking? Where everywhere we can't reach as a bank, so we have to make agreements with the bank that are available there, so they will do all the things related to each other banking activities, right? Okay. So this is the introduction of the correspondent banking. Now the thing is that we need correspondent banking. We learn this thing why we need, just because of money saving and lots of restrictions and lots of things are there to open a branch in anywhere. We need lots of things, right? Then now, what are the functions of correspondent banking? there are account based services, clearing house function, which handles incoming outgoing payment, which settles letter of credit payments, check collection, which gives account statement, which allows short credit line during the day. What is the meaning of collections? Which collect export import bill and checks, follows up with buyers, and also provide lockbox or cash letter services for faster check collection. There is payments, in which it executes payment instructions sent by the Indian bank, which is you basically these payments are used for foreign exchange deals, import payments, etc. Means lots of services we need in this, in a function of correspondent banks, and it also gives overdraft and loan facility. Then investment services are there, but what are the known account services? Letter of credit advising and letter of credit confirmation. What is letter of credit? It is the agreement between the banks of importer or exporter, that we will read in our next chapter. Then arranging buyers and suppliers credit, bank guarantees, foreign exchange and derivative products, custodial services, credit reports on foreign buyers, arranging the bonds, ADRs, American Depository Receipt, and Global Depository Receipt trainings and seminars. So lots of services are there in the correspondent banking. Then what is the meaning of FATF? FATF and de-risking. FATF and de-risking. See, cross-border correspondent banking generally is more risky. Why? Because banks depend on each other compliance activities or compliance quality, right? There are FATF recommendation that requires full reporting of all the transactions. They required no simplified KYCs allowed. They also enhance the due diligence. Bank have to avoid relations with foreign banks that do not report their transactions properly, right? So banks have to report those transactions. So this is basically FATF. What is the meaning of Nostro, Vostro, and Loro account? When a foreign currency account maintained by Indian bank abroad, when a foreign currency account maintained by Indian bank abroad, that is called Nostro account. SBI Mumbai keeps an US dollar account with Citibank New York, that is called Nostro account. And what is Vostro account? Your account with us. Means when a foreign bank keeps an account in the India with an Indian bank. So very simple. Nostro account is when foreign currency account maintained by Indian bank abroad, and when a foreign bank keeps an account in India with an Indian bank, that is called Vostro account. So American Express Banks keeps a INR account with SBI Mumbai. So in SBI books, that is called the Vostro account, and currency is INR, right? And Loro account, when their account with them, a third party account reference, like Citi refers the rupee account of American Express maintained with SBI Mumbai, that is called Loro for Citi. And what is the mirror account? That is the shadow copy of Nostro, which is maintained in home currency and foreign currency in the home book banks, that is called mirror account. Then let's learn about the SWIFT today. What is the meaning of SWIFT? SWIFT is Society for Worldwide Interbank Financial Telecommunication, one of the most important or most popular one. It is used for sending safe, authenticated banking messages. It covers more than 11,000 institutions in 200 plus countries. It works 24 into 7 into 365 days. It uses relationship management application for authentication. It is the only a messaging system, not money transfer itself. It basically sends a swift message to city instructing US dollar payment to a beneficiary. So what is SWIFT? One of the secure global messaging system. So now about chips, Fedwire, chaps, target, we will learn in our next class. So I hope that it is helpful for you to learn about the foreign exchange, to learn about the liberalized scheme, to learn about the correspondent banking. I hope that it is helpful. If any problem is there, so kindly ask me in the comment box. If you need this PDF, so you can also tell me. If you like this session, so kindly give the like and just make this BFM journey easy in just 7 days. So thank you so much. Let's meet in our next class. Till then, take care everyone and have a good day all. Thank you.